Kathryn Rooney Vera's take, Chief Market Strategist over at StoneX Group. And Kathryn, we've heard from the likes, for example, of Mike Wilson over at Morgan Stanley, just talking about how this signal, the fact that NVIDIA boost really the overall market, is a technical signal that this rally is exhausted. Are you, for one, agreeing with that or not?
Well, the chart in the video is back to its 7-year forward PE multiple, so that also tells us something. At StoneX, with our trading desks, we have seen an increased interest for the past 3 weeks since I came out recommending the protection on the option with puts, either put spreads or naked puts. That has been remarkably profitable, and our clients have benefited from that perspective. And that was because, Caroline, we thought that tech was overdone with almost year-to-date 50 basis point appreciation at that point. Now, in the macro context, with the Fed trying to persuade markets to believe that it's not going to change its 2% target, that it's serious about its 2% target, that it has a strict interpretation of its dual mandate, that to me says that 2024 is unlikely to be as much of a boon for this sector as we saw it in 2023.
You know, we're just a couple of hours post-Powell, so where we've left it is that it's too early to declare victory on inflation. They're going to be careful about raising rates, but I think the conclusion is higher rates, steady for longer. To your mind, Kathryn, how does that relate to the technology sector? How do we price that into the tech sector in public markets?
It seems that the markets have not priced in reality. Markets still in easing next year. So that tells us that currently priced into multiples is the best case scenario. So the soft landing, which is, of course, 2% inflation target attainment with no economic contraction, I think is unlikely to manifest unless the Fed does, in fact, either implicitly or explicitly change its 2% average target. So if it's serious about that target, and it does have a strict interpretation of said target, then I think that 2024 could be a difficult one for tech, and I would expect that the most interest rate sensitive sectors, such as tech, such as consumer communications and consumer discretionary, would have a tougher time. So I think utilities is up today. You know, I think that we have to be more defensively positioned. I like cash. I like gold. I like sectors that are defensive going into 2024 because the Fed is going to be in a tough spot. Either go for that 2% target and maybe even have to hike further, which has been my long-held contention, or change it explicitly or implicitly.
I want to go back to this micro narrative, though, because you paint a really clear macro picture. But there has been this almost ability for tech to outshine because of the productivity boost many are factoring into artificial intelligence. Now, I know that that's been questioned at the moment. I just want to go to what Steve Sosnick had to say on Bloomberg television a little bit earlier about, well, the concern about lack of institutional buyers at this moment. Just take a listen, Kathryn.
You didn't get the institutional follow through that I think you got, you know, from the first round of buying, and without follow through and with perhaps a little profit taking, you know, you end up with a messy kind of blah day that you had ended up with yesterday.
So I just return back to it a little bit. Are there any names that are still, the Magnificent Seven, for example, going to tread water because of AI?
No, AI certainly has a long longevity and long path therein, but a lot has already been baked in this euphoric AI. Now, markets try to price in ahead of time what's going to happen in the next 5 years. It's already been priced in. So AI has to deliver now. Certainly, it is positive for productivity, but my concern, perhaps reverting back to that inflation story, is productivity at current levels would have to accelerate meaningfully in the near term. That means that AI would have to really deliver in the next year to really compensate for 4% inflation. In other words, productivity is not sufficient at the current growth rate to make up for 4% inflation. So inflation stays around, AI is not there yet, and the Fed is going to have to stay on hold for the entirety of next year, again, negative tech, or potentially even hike, because inflation is very likely to reaccelerate under the scenario of soft inflation. This is an economy based on consumption. The consumer is strong, real wages are positive, and they're trending higher. That is not a good environment either for the Fed's 2% target or for rates coming down.
You know, Caroline, I sit here on a Friday morning asking myself, what happened? What a weird week. 24 hours ago, JP from Franklin Equity Group told us that the NVIDIA results were like The Godfather 2, where the sequel is as good as the original. But on a two-day basis, the stock's down 4%. It's like it never even happened.
Yeah, all you got to, within that, Ed, remember how far we've charged higher. More than 200% gain on this name throughout the year. The key outperformer of choice. Maybe it is just this moment to profit take. But, I mean, to that end, Kathryn, it's really fascinating that you say sort of AI's got to deliver. Well, it kind of has been, at least at NVIDIA. I mean, we've got currently earnings expectations for 2024, their fiscal 2024, 171% growth for the next quarter that we're currently in, 178% revenue, so doubling even out until their first quarter of 2025, their fiscal. So with certain, what more do you need to see in proof in the pudding that really AI is here and is driving revenue for not just NVIDIA?
Yeah, I would have to see it flow through into the productivity numbers. So we would have to get that boost in U.S. productivity in a meaningful way. Remember, in the past 6 quarters, productivity was only positive 3 of them. So yes, the last quarter, if I'm not mistaken, around 3.7% annualized was positive. But I would like to see AI play into the real economy, Caroline. AI, everyone's talking about it. You know, you go into the corporate earnings and guidance, and corporations are well-intended, but maybe not all of them are deploying it. So I think deploying takes time, and certainly we're pricing that in today, but it has to flow through to the real economy over the course of the next 5 years to offset inflation. And NVIDIA, very interesting. You know, I think reverting back to its 7-year multiple is great. I'm not saying, you know, sell all of your tech sectors, but what I am saying is that volatility to protect those positions is relatively historically cheap. So why not deploy it rather than go into a potentially volatile 2024, you know, for lack of a better word, naked? You want to be protected.
You know, I'm so glad you asked that, Caroline, because we're at the tail end of earnings season and it's almost September and we'll be back in the next one. And you wonder, do we go through the same expectation from an AI-driven growth cycle that we did in the last 3 months? Extraordinary. Kathryn Rooney Vera, happy Friday to you, Chief Market Strategist at StoneX Group. Good way to end the week. Now,